Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the 2024 housing market so far and whether we're getting back to a normal level of inventory and home sales. First, though, we're going to talk about jobs. Logan, welcome back to the podcast on this momentous day.
Yes. So as always, this is Wednesday morning. Labor over inflation. We're doing the cup. The job openings data did come out today, and it's interesting. The headline number is heading towards 7 million. That's kind of been the target for me. And the internals of the data look very interesting because the hires portion of the job openings data is at recessionary levels. It's like, at a level where in 2008 we're losing jobs, but the layoffs, haven't deteriorated. And that's one of the things, we've talked about during the COVID-19 recovery, that the demographics of the U.S. labor force is a little bit different now. That you have one massive generation that's retiring, and then you have another massive generation coming in. So for certain companies, they can right size their labor force to meet their profit margins, but you're really going to need to see like authentic, real demand weakness to start laying off people, because last thing you want to do is get into a rehiring battle with certain parts of the U.S. where the prime age labor force growth for younger people isn't as strong as others.
So I feel like over the last couple of weeks, it feels like not exactly whiplash, but it's like every time I turn around, there's a different report that's like, because I think the last time you and I talked, we were like, people were saying, oh, maybe it's, maybe it's not as strong as we thought, or this what's happening. And then today we have this report that makes it feel like we are on the right path for rate cutting.
So the labor market has been deteriorating for many months. That's the given. The Federal Reserve chose to ignore that on purpose, right?
Right.
What was the whole thing? Paper, rock, scissors, labor over inflation. So we're at the point where we have no rate cuts. Canada just cut rates 3 times. So they needed cover. So the more weakness that you see in the labor data reports, remember Bostic just came out yesterday, or just came out like an hour ago, said, it looks like we're balanced between inflation and labor. I mean, we went from maybe 50 cuts to, I need more data to, I mean, there is a point to where maybe some Fed presidents just shouldn't talk, because if it just, you can't go from 1 week doing this to that and stuff. So we're waiting. By the time this podcast comes out, the jobless claims data is out, the ADP report is out, but jobs Friday. Again, trend is your friend. This has been going on for many, many months now, right? This isn't just coming out of the blue. The question now is breaking labor market or softening labor market. Breaking labor market needs jobless claims. You always want to get ahead of that, right? You don't want to wait till, oh my God, jobless claims are breaking, we need to cut. No. If you really wanted to do something to keep the expansion going, you get ahead of that. Thankfully, the 10-year yield is not old and slow. So there has been some financial conditioning is getting easier on that part. But imagine if the 10-year yield was like 1-to-1 with kind of the Fed funds rate. We're 8% mortgages. 10-year yields up there, but that's not the case. The Fed follows the bond market. So in this case, there has been some relief by mortgage rates going lower. So that's a positive. Again, the Hordor line, it's cute now. Every time the 10-year yield goes below 3.8, I get a bunch of people on Twitter, oh my God, it's happening. So I was like, gentlemen, we need to have a close below 380, and then we need follow through bond buying. Nothing's happening here. We had the 10-year yield at 3.66, and you guys were all hysterical back then. Now, so let's, the 10-year yield had fallen a few basis points. We're at 3.78 now. It's back up to it's going to need some more weakness to go here, or the Fed just starts really talking dovish out there. So trend is your friend. We're heading down here. We're actually getting toward the low end range of the 2024 forecast right now.
Okay, so these are the last these are the last reports that will come out before the next Fed meeting, right? Is today, Wednesday, obviously Friday, huge job number for us, right?
Yes. And again, whether it's good or bad, the trend is here. So of course, if it's a big miss and wage growth is slowing down faster, there is a chance where the Fed, in a sense, some people would see that they're panicking, does a 50 basis point cut. Again, for me, it's like I wouldn't have done the last 6 rate hikes. It's like this is
Yeah,
the
right.
if people haven't realized this is a global pandemic, we would not be having this discussion today if there was no global pandemic. We had zero interest rate policy, QE1, QE2, everything during the last decade. It never created inflation. We had higher oil prices from 2010 all the way getting close to 2015. We never had breakaway inflation. But the history of global pandemics are very inflationary, and then the disinflation happens, right? Just because the supply chains are working a little better. Obviously, the U.S. had the best performing economy, but the U.S. always has the best performing economy out of a kind of a recession period. It was a very brief recession. Sarah, do you know we wrote literally the COVID-19 recovery model on April 7th, 2020, and
I
that was the
remember
point
it
where
well. Yes, I
yeah,
remember it
so
well.
everything kind of looks right. So we're trying to get to that next stage. So I see how a lot of people are excited. Purchase application data came out today. It was another positive print. And just remember, if you're listening to people that says there's nothing positive with the purchase, that's not true. We've had now 13 weeks since rates have fallen, 8 positive, 5 negatives. That makes it the best 13 weeks of the year because it was a very, very negative year on the weekly data. So there's a material change there. And of course, the new home sales had a big beat. Their purchase application data has outperformed the existing home sales market, and the builder's confidence going out has improved a little bit. So there's clues there, just have to be able to read it. Hence why we created the tracker article for everyone every weekend.
The tracker article. So we're going to get into that. Before we do, I mean, it relates because you always cover purchase apps, but with 13 weeks, what's the kind of momentum that you need to see in purchase applications? What's the time length there before something really changes?
So I always say if you got like 12 straight weeks of positive trending data, you got something. That only happened toward the end of 2022, right? So it was, for those that don't know what we're talking about, the existing home sales market was crashing in 2022, but there was a premise that the next move in rates would be lower. So if the forward-looking data gets better, you have to go with that. What happened is you have a lot of inexperienced people who say they're housing experts, but don't forecast and have no working models. So after November 9th, 2022, rates fell. The forward-looking data, November, December, January, all the way up to the first week of February, were all positive. That's material. That's, a quarter of the year. That was the only time that I saw, and we had this massive existing home sales print, like over 500,000, all in 1 month. That was something material. Here, I wouldn't call it something like that. I would just say it's a positive curve. We're no longer negative, but we're slightly positive right here. So over time, that does help out. But what this has done is actually it's slowed the inventory data down. And this is why on the weekly tracker, we create our little models here to give people updates. And over the last 5 weeks, especially as mortgage rates got below 7%, I haven't hit my weekly growth models once, which is perfectly normal. And this last week, we had a slight decline on a week-to-week basis in inventory.
Okay, let's jump into the tracker and inventory specifically, right? So these are all you break out all these data lines every week in the tracker, usually on Saturday. I think this last weekend it was Sunday because it was a holiday weekend and we were still making sure all the numbers worked right that we get from Altos data, very fresh data. So let's talk about inventory in a little bit more detail.
My premise is that the mortgage rate lockdown people
I know you're trolling me there.
are looking at housing data a little bit differently because active inventory can grow. Now, new listings data. So part of the tracker is we do this new listings. These are the homes that are coming onto the market that don't have a contract right away. So in 2021, a lot of people said, which I'm hearing again, mortgage rates going to go down and millions of people are going to rush to sell their homes and home prices are going to crash. This is a favorite of stock traders. So what is one of the key things? We never, ever listen to stock traders on housing economics. Their 200-day moving average and all that. None of that. works here. Okay. Because you as a seller is a buyer of a home and you need shelter. Now, middle-aged men stock traders will sell their homes, run around the world for whatever. They don't have like relationships with their families or a stable life. They're all over the place. So I can see why they would do it. But normal Americans don't operate that way. You have some crazy spreadsheets dads that go around and go, oh my God, we'll save money. But generally, you live in your house, your kids go to school and all that. So 2021 shocked a lot of people because rates went down to 3% and new listings data still trended at the lowest levels ever. However, now that we're in 2024, every single time that rates had gone up and we saw softness in demand, the inventory data has been able to grow. We saw that in 2022. We saw that in the middle part of 2023 going out to the rest of the year. And in the early part of this year, we saw that again as well. The inventory is growing. Whenever rates go down and demand picks up, now demand's not picking up in any big fashion. If we authentically saw a rebound in sales, purchase application data would be growing every single week. We'd have these year-over-year data lines that'd be positive. But every time rates go lower, the growth rate of inventory has slowed. So last year at this time, mortgage rates were heading toward 8%. Remember the Fed? Hawkish Fed. Fed was like, oh my God, inflation is out of control. We have to, I was like, really? Did you really have to? And then the 10-year yield went to 5%. We had 8% mortgage rates, and the Fed's like, what's happening? I didn't really. It's like, you guys did it. You guys could have. No, you didn't. So inventory growth went all the way till November, seasonal. That's very rare. So we saw the last 2 years do that. Now it's just slowing down. We probably have a few more weeks left of maybe some inventory growth, but the market is stabilized in that sense as lower mortgage rates slows down the inventory. The weekly demand data that we do on the tracker article shows the year-over-year growth is picking up only because last year was such a low bar. Purchase application data as of today had the smallest year-over-year decline going all the way back to 2022. It's crazy to say that, but it was only down 4%. Now, that's because we have the lowest bar ever, right? And we're going to have some really low bars coming in October. So you're going to see some positive data coming out. So just remember, context is key. But it's stabilized. It's such a beautiful thing just for me personally, because it's 2024. It's the end of 2024. And these 5 years were my baby. And to see the model actually close out this 5-year period as it should in a correct way, that's why the tracker is created, because we show the new listings, the active listings, the pending contracts, the price cut percentages. Price cut percentages have slowed down in the last few weeks. We also incorporate the 10-year yield, mortgage rates, what drives it, the spreads, right? This year, the story is the spreads. The spreads are better, right? We would have like 50 to 60 basis points higher rates today if the spreads didn't improve from the worst levels of last year. So there's all these things that are good. But for me, just personally, the fact that we're off of the 2020 to 2023 inventory, this is why I love Sarah Wheeler. I love 2024. If I could get to and give it a big kiss, it just did. We finally got off of these depressed historical levels. And part of team higher rates in 2021 and 2022 is so you don't have to worry about a housing bubble crash, inventory skyrocketing. People just know all that stuff. Professional grifters. None of these people are talented, educated, have no working models, never forecast. They're all dancing with a ghost because their only fantasy in their head was 2008. This is what doomers do. 2008 was it was their only time to live, in the last 100 years. But different marketplace. You tested it now, 2020, 2021, 2022, 2023, and in 2024, right? So new listings data is second lowest ever. Homeowners are doing good. The growth rate of inventory slows with low rates, perfectly fine. We got off those levels. The tracker article kind of incorporates everything so everyone can visually see. Those charts are designed to be very visual, easy, and then you are ahead of everyone else on planet Earth. We don't have 4-week moving averages there. We do the raw weekly data, so everybody's fresh, and you don't have to listen to crazy people.
Not listening to crazy people is such a life hack. And I mean, people listen to them because they don't know they're crazy, or they get served that by the algorithms or whatever, or people that they might respect on social seem to agree with them, which is why you spend a lot of your time on the weekends, especially just, making sure that those people don't have as much of a voice.
The history of human civilization has taught us disenfranchised fanatical groups have taken advantage over people who don't read and understand data. I've seen it throughout history, right? This is no different now. But here, because of social, which in generally I hate social media anyway, but because what it does. But here, at least I can show people, right? I can show
Yeah.
people forecasts and models and everything, and think about educating an entire society to understand data better. Oh my God, that's like if I do that, if I go pass off to the afterlife, I did my job, right? And that's the beauty of the tracker data. That we try to get that up as quickly as we could, and so then everybody's on the same page right
Right.
now. So again, I encourage everyone, read it, visually see it, take it all in, right? And then realize that a lot of the data reports that you're reading are months old. We are current, looking out forward. So by the time, in 2023 was a great example, the housing crash, people were completely like whiffed that, home prices hit all-time highs by June and July. And all of a sudden they're like, well, what happened? And I was like, you guys are going to be months behind because you don't have any models, you don't track forward-looking data. But if you read the tracker, you would have done this. And how many videos did we create like November, December, January? We're like, guys, the market is changing. None of you are going to realize it until months ahead. And what happened is like, what? What happened?
No, it's so true. Okay, so let's revisit. So in I think it was 2021, you coined the phrase "savagely unhealthy housing market," or was that 2020? It was
No,
2021, right?
2021 was the unhealthy housing market. We need higher rates. That was,
Savagely unhealthy.
yeah, savagely unhealthy came in 2022 because
Okay.
what occurred was in early 2021, remember that was a whole forbearance crash bros we had to deal with, right? Everybody thought lower mortgage rates, forbearance was going to crash the market. And I was just like, oh my God, holy Toledo, can you be any wrong? It's interesting because 2021, going back 82 years, was like the third hottest home price growth year post World War II. The year that forbearance, God, I do miss the forbearance crash bros. They were hilarious
No.
because you ever know dragging a carcass out for 3 years? Because they keep on saying it. It's just like, no, it doesn't work. You guys, it ended like September and October of 2020. So, but that was the hey, it's unhealthy. We need higher rates. It's not the housing bubble, but we do need to slow this down. 2022, by February, I said this is the worst housing market ever. It was post 2010, just not because home prices were crashing and people were losing. It's just that the price inflation we would have had a 17 to 19% home price growth year that year if rates didn't go up. But rates did go up. It slowed the market down. It crashed home sales, which of course housing has been in a recession for 3 years, but it kept everything somewhat intact because the credit markets are different. So you pay the price for not having enough product, and that's what
Right.
happened here. And if rates hadn't rise, we would have had faster. It's just because too many people are chasing too few homes. This is why I always remind people on the Nur Tour, we only had 240,000 single family homes available for sale in March of 2022 in a country of 336 million. Now it's over 162. No, that's not a functioning marketplace. So 2024 is a good thing. We're off of those levels that we saw in 2020 and 2023. So positive, right? Positive housing, because if rates go lower, if the labor data gets softer and rates go lower, we have more product available and we don't have to worry about, there's parts of the US, of course, are like near all-time lows. That's still savagely unhealthy in my mind. But in general, we're in a much better place now.
I think one of the difficulties is we're all trying to figure out, okay, when are we back to normal, right? And you pointed out in a recent tracker that we use 2019 just because it's before 2020, right? But 2019 itself is not really some bellwether event that we're like, yeah, that's the normal housing market that we would all like, right?
If you're looking at the NAR data, the normal active listings going back 5 decades is between 2 to 2.5 million. Of course, we have a lot more people now, right? What the doomers never show you is the homeowner's vacancy rate, because that would just ruin everything. It's like we're 0.9%, right? Once it gets above 1.5%, it heads up higher. Then that's a high percentage for the vacancy rate. But 2019, the days on market were 30 to 45 days. That was good. I wasn't a low inventory person in the previous decade. I used to make fun of people. It's like people say, there's no homes to buy. Oh, there's plenty of homes to buy. It's just you have a very high opinion of where sales should be. But if you get 1.52 to 1.93 million NAR data, it should have days on market grow. And what we saw this year, like for example, the last existing home sales report, it's 24 days. The year before is 20 days. So we're not quite at that 30, but we're getting there. And the more product, the more more choices, these are good. Of course, 2007 total active listings were 4 million. And then again, the new listings data, like we always try to stress this, 2009, 10, and 11, those years were running at, 260, 365, 385. Those things were all those forced credit
week,
sellers
right?
into the market. Yeah, that's per week. And the last data was 59,000. So it's like, if you compare this to one of those years, it's like 365,000 versus 59,000. There's a difference, right? Because homeowners, the credit markets have changed. So I would feel much better if it was 2019 inventory levels, because there's more choices. But considering what we're doing, that, this only could happen if the labor market was intact. Once the labor market breaks, then the rates go lower. So you couldn't be one of these, oh, we're going into a recession and the 10-year yield is at 5% and 8% mortgage rates, right? The labor data had to not break to keep rates elevated. Now we see this, that rates are heading lower at some of the market dynamics. And again, we create the weekly tracker so you are not old and slow.
Now, okay, I'm going to say a couple of words, and I need you to not get triggered by these words, okay? Because I know you don't like these words.
Why are you going to say that?
Because I know you're going to.
Now I'm ready to go. See, it doesn't work that way,
Okay, here are the words I'm going to utter and ask you about. Basically all of the homeowners, the potential buyers that have been sidelined. So, these people who are waiting for rates to go down before they buy. And I think we can say there is now, there is an excess of people who would have bought if housing in general, we won't say just rates, but if housing in general was more affordable for all of these variables, they would have bought. But they have been sitting on the sidelines, and now they're going to be unleashed if rates go down. So give me your thoughts there.
I disagree with that premise. See, I said it in a nice way.
You did. So
housing is a total PITI cost, right?
Right.
So what are a few variables right now that are changing the landscape? Property taxes and insurance, right? The purchase price that you have is actually, how much you are able to put down, and the balance that you're borrowing is a big determination of where your total payment is. So I will never use the rate variable. Now there's millions of people buying homes still. We're going to have near 5 million total home sales. The affordability crisis doesn't impact them as much as the marginal home buyer. Now the marginal home buyer, I would argue, I don't like the pent up demand thing ever.
Oh, those are the words I was looking for. Pent up demand. That's exactly.
I always thought that was a marketing gimmick, but here in this case, we're missing about 4.2 to 4.7 million home buyers from this 5-year period, or the last 3 years since rates have risen. You can make a case that if the cost of debt comes up, you can get some of those people back into the marketplace because the cost of debt, but you still have to deal with the reality of the prices first went out of hand. Because in a qualified mortgage world, you can't fluff anything anymore. You have to go. So prices first, then rates, then you got to do taxes, insurance, and then wages and everything. And it's a whole working variable that you can't just put on one thing. But of course, whenever rates go down, that's the fastest way to make housing more affordable or make it least affordable. That's the variables we're working. And again, when you're working from the lowest levels of sales ever recorded in history, it doesn't take much to move the needle, right? But I've seen this only happen with the new home sales market, and the new home sales market is a sub 6% mortgage market world. They have been able to grow sales since the bottom of 2022. So you can get that, but I can't say, if rates come down lower to 5%, we're going to get a V-shaped recovery and it's going to be back to trend. There's going to be more buyers. There's going to be more people buying, but you pay a price with prices escalating out of control. So it takes time. Wages have to grow. Households have to form. Certain people have a little bit more down payments. So there's all these variables, but we've always seen that if you get a sub 6% mortgage market, the builders can do it. Then considering how low existing home sales is, you can grow sales from there. That's how I would answer that question.
It's a good answer. And now
was I triggered, Sarah? Did I go off?
You seem less triggered. And
you have never seen Logan Unleashed.
Oh my gosh.
You
Okay.
have never ever even come close to this,
Okay.
being
See,
unleashed.
this
So
is
I
okay.
have been calm but if it ever happens, you're going to realize, wow.
I will realize, but I'm going to mark that down in the column of you believe right now that there is such a thing as pent up demand. That given what we've
Only,
seen,
only in the context is that sales had the record breaking crash. That's it. If home sales weren't trending around 4 million, I wouldn't even say that. But because we've had the third calendar year of the lowest home sales ever, just due to that variable, rates go down, you could pick up sales. But I've never liked the pent up demand theory. I've always thought it was a marketing thing that people said for 15 years. By the way, the sideline home buyer, I used to make fun of that. Like the sideline home
I
buyer is
know.
like Bigfoot. You see, oh, there's a Bigfoot, there's a sideline home buyer. It's like what people used to do is like rates fell down for like 1 week and then purchase application data would pick up a little bit and people go, oh, that's the sideline home buyer. And I would be like, no, I mean, those people were generally like looking to buy and rates went down, you get a little bit pickup. It's not a big variable thing. When you get real growth in housing, boy, the purchase application data every week, year over year growth, week to week growth, considering how low the demand is. So you can get an uptick, definitely for sure. But I'm just not a fan of the pent up buy, but I could use it here just because sales are low.
I will take it as a win. I will take it as a win for the people who are talking about pent up home buyers, even sidelined home buyers. They're really basically the same thing, Logan. So you may not like it as a phrase, but you
I'm
just
being
said you can see
calm.
it.
I'm being calm.
You're being very calm. Okay, well, thank you so much. The next time we talk, we will have even more information about where jobs are at. But appreciate you giving us your insight on all the things that came out today, and just we'll talk soon.
Yeah, and when Friday comes out, the Friday article, depending on what happens with the jobs, we're going to get all these updates and the revisions. And now, people have to realize that with these negative revisions, it's actually more in line to my forecast. So I have a much different take than everyone. But when I write that article on Friday, it's going to take more of an encompassed look of everything where we are. Again, labor market's breaking and softening are two different things, but we could kind of show a trend. And this is why I'm a big job openings person, big jobless claims, the internals of the data lines. And we try to make it as fun as possible for a very nerdy topic. But Jobs Friday will be big because it's the last jobs before the Fed meets.
Big week. Thank you, Logan, for joining us, and we'll talk again soon.